All right, so what I want to talk about today is how to create investor reports that investors will love. And we've started raising capital from investors in 2011. And throughout that time, I've written some really great reports. I've written some really bad reports. And the reality is, you're never going to please every single investor, and every single investor is different. So you're probably not going to be perfect for every single investor. But what we tried to do is figure out a way to appeal and make the most amount of people happy. And one way we do that is by open and active communication. So we have a investor relations department which responds to email questions and other requests from investors, usually within 24 hours. And it's a general email address. It's easy to remember. And then for more detailed questions or conversations, those would either happen with our CIO, Charles, who's great communicating what's going on with our investors, or they will happen with me. But there's a lot of requests that are just around basic housekeeping items. I have a question about my K1. I didn't get my K1. How do I access the portal? All those sorts of things. And as we've evolved, we've really found the need to have a full-time investor relations person. We have close to 1,000 different investors that range from high net worth people to family offices to some of the world's biggest real estate institutions. And each one wants something different. Each one has a different level of sophistication, but generally people have similar goals, and you're going to have to figure out how to manage your time and how to communicate effectively. And one of the ways we've found to communicate effectively is to issue quarterly reports to investors. And we often issue quarterly reports to our investors so that if they are an institution or maybe a fund of fund, they can basically take a lot of the information from our report and copy and paste it or translate it into a report that they might create for their own investors. Otherwise, our investors have a great package if they're just using the report for themselves to review and really understand the deal. And when we're writing an investor report, we really try and think through all the questions that an investor would have and try to answer them in the report. The reality is, though, a lot of your investors probably aren't going to read your reports. And I think a mistake that a lot of young GPs and founders make is assuming that investors read every email, see every email, and think that what the GP or founder says or sends is the most important thing in that investor's life. And the reality is, it's not. In many cases, these investors have very large investment portfolios. You might be one of 10, you might be one of 100. So you can't always assume that an investor has read everything. And you also need to create a report, we found, that will be very easy to digest, easy to read for someone that's going to spend 5 minutes on it, but also informative enough for someone that's going to spend 20 minutes on it. And the other thing that you always have the option to do is send them more information if they request it. So that's something that we do and we say in our reports or we say in our emails. If you want more information, if you want to see something else, see it in a different way, if you want to know more specifics about this financial item, then we'll send it to you. And I found it's better to not overwhelm investors with too much information most of them don't need. And it's best to give them what I think they need and what they've told me they need over a few years, and then supplement that with requests that come down the line. There's a couple different ways to share investor reports. You can write them, you can host a phone call, or you can host a Zoom call or webinar. For us, we've found that it's best to write them because then there's a written record that someone can take home, they can read it, they can refer back to it. We've done a lot of video reports and updates, and those are great. The problem with that is if you have single deals, so let's just say you have 10 one-off deals, how are you organizing that? Are you having just one call, one 2 1 hour call where you're going through all your deals. Well, what if an investor is just in one deal? They're not going to want to sit through all these other deals most likely, and you probably don't want that either. So another way to do it is to host different video calls at different times for different deals. But then ultimately your whole life and your whole business is going to be taken up by setting up all these video calls and hosting all these video calls. Another way to do it, if you do like video, is to actually record smaller 5-10 minute sessions for each deal. So if you have 10 deals, it's 100 minutes. You could plan it out over a week. It's not that complicated to record, just like we're doing here. And you could walk someone through a deal. You can give them insights, and then you can also follow up or follow through with supplemental information. There's definitely no best approach, but the approach that we found that works best for us and our investors is to do a little bit of a hybrid. We send a quarterly investor report, and then we also twice a year do video updates. And they're typically with me, maybe they'll include Charles, and we're talking about the deal for 5 or 10 minutes. It's like an executive overview of the deal. It's not really shooting from the hip, but it's our impressions of the deal, our strategy, as if we were on a phone call with an investor, walking them through the nuances. Now, obviously, we don't have memorized all of the financials of the deal. We know certain KPIs and the key components, but worth talking through, just like a CEO or a CFO would do on an investor conference call, the performance over the quarter, over the year of the asset, of the investment, and giving a straight shot. The other thing that is very, very important is I think you have to be brutally honest with your investors, and you shouldn't sugarcoat things, and you also shouldn't be overly optimistic about things that might not pan out. And it's a fine line, because you also don't want to just be kind of doomsday and kind of subtle and then show up one day and be like, oh, yeah, we sold that for a 3x, and not be excited or not have led the investor into that momentum. Because if they've kind of just thought your deal was like a 1x, and then you show up one day and say, oh, we sold it for a 3x, the investors actually aren't going to be that happy, most likely, because they would have liked to plan for that event. And it's best to communicate what you know open and honestly, but only the information that I think is really going to move the needle on the investment or is solid. If there's something that may or may not happen, depending on the level of severity, it might be good to share it. It might not. You're going to have to make a judgment call on those things, and you're going to learn as you continue to raise capital from investors and continue to do these things. During COVID, when like the world was falling apart in hospitality and literally everyone was calling us, and we had to close one hotel in an instance for a few months, and we didn't really know what was happening. There were all these government programs. We were sending investor updates almost every 2 weeks, and it was just kind of coming in an email that I would write, and it would be very general for a lot of our hotels, because most of the things that were happening, one, were happening in many. So we would share in a single email what we were doing, and we would be very honest about it. And some investors maybe thought they could help or thought they had an idea, so they would call us and share those things. I'm also going to go through mistakes that we've made, and I'm also going to go through Q&A. But what I want to do now is I can walk you through actually what one of our investor reports look like. And I'm going to start with a fund that we have and walk you through that right here. So this is Dove Hill Sponsor Fund 1, 2025 Q1 report. Let me get over there. This fund has basically almost 10 different investments in it. So it's very different than a single deal. I'm going to go through a single deal next. But what we do, because it's a little bit longer, is we have kind of the scheduled investments, the investment overview, because you got to remember, you are not the most important thing in your investor's life. They might forget what the deal was. They might forget what you said you were going to do. So it's always important in an opening to remind investors what the deal is, the basics of the deal, some of the KPIs, your business strategy, the business plan. Even though it sounds basic, you should still share it. Now, this investor report is 171 pages. You might say that's insane. It is insane. I always think that having these big reports are ridiculous, but you got to keep in mind that this report covers 10 different properties. So it's that long because we have kind of market reports and other things that I'll share about each property. So this next section is really just a summary. Here were the investments that we made. Here's what they were. Here was the story of each one. Actually, last week we just sold this one, the Courtyard Hotel Chelsea. It was a preferred equity deal we did in the depths of COVID. The hotel was actually closed when we invested it. Over 4 years, it returned an 18% compounded return, and it was phenomenal. So it says, which is expected to yield a 17.5 IRR. It actually was over an 18. So it's always best to undershoot. We over delivered in this case. So that is fun. So just again, quick highlights on the deals and the different investments that we made. And it's really an executive summary on each deal and the background. Then for this fund, we have a table that shows all the investments, the amounts, how much money we've distributed, which we call DPI, distributions to paid in capital. That's how much money you have distributed versus how much money you've paid in. And we show it per deal. We also show what the expected returns are of the deals as a good refresher. Then we go into specifics on each deal. And each one of these, I'll show you what a specific investor update looks like on one asset, but each of these we kind of get from our operating partners, because in some cases we don't operate these hotels, and then we'll fill in things that are relevant to this specific investment. So because it's for the quarter, we'll show financials. And one thing that we do is we take financials and we summarize them into key components and make them look pretty. If you're just copying and pasting Excels from your model or from your accounting chart of accounts, people's heads are going to explode and they're going to get pissed. So we make it look a little bit prettier. Like if you were looking at a deck for a property sale, it's similar to that. And we really boil it down to the biggest components that an investor would need to know to really check the health of the property and of the investment. And you'll see here that we show it with debt service. So what's the income after debt service? We'll show the gross revenues, gross operating profit, management fees. We'll show kind of any below the line items like property taxes and insurance and any reserves, and then obviously debt service. Then after that, we kind of do a recap of the whole year. That was just for the quarter. So we'll show what the returns were over the whole year so they could really see on a quick chart very quickly what the health is of the investment. And we call like this a stupid Sharpie math. Like, okay, what's my income? What's my debt? That's what I put in my pocket at the end of the day. Obviously, there's other expenses and things that come after that. And then here we're showing an operations recap, which is basically a report from the hotel's management and asset management team. We rewrite it in our own way and include that here. And then we have a star report in Hotel World. Star report is how your hotel is competing against another hotel. Then we go into some more detailed financials, a little bit more expanded on the hotel performance because every hotel is an operating business. So this looks very similar to a hotel profit and loss statement. And in this case, we compare year over year or quarter over quarter, depending on what type of report it is. And then we'll offer an additional star report. Then at the back of this, here's another asset, again, similar setup. At the back of this whole report, we have an appendix, and in the appendix, we include certain reports. You can get reports from CoStar or CBRE on the market, and it just shows what the hotel market is doing generally in that city, in that location. And it's really important to give investors context because they should know what's going on in the market and how your hotel is performing relative to the market. Those market reports also talk about what economists think the forward forecasts and projections are for the market. So is next year going to be good, bad? Is it going to be up or down? Is rate going to be higher or lower? Now, obviously, these are all projections from, professional fortune tellers, but it's good context and market data to have so that investors have an idea how you're performing. Maybe it's a good time to sell. Maybe it's a good time to refinance. What's the lay of the land? So I will go into now a single investor report, just so you can get an idea of of what that looks like for one investment. Hold on, I'm trying to get this little screen out of the way. Okay. So this is for a hotel we own close to the water in Fort Lauderdale, the Renaissance Marina Hotel. And again, we write this. So here's the recap. Here's what the distribution was. If you're making a distribution, always highlight that out front. It's very important. One thing we always do is also we share capitalization of the deal. So how much debt do we have on it and what's the equity? This is important because investors are always trying to figure out how much the hotel is worth. Maybe they're doing, on a price per key, maybe they're doing it on a cap rate basis. And they always want to know these things because they like doing simple back of the napkin math. And we put the capitalization table here. If you have a deal that went through COVID, there might be kind of unique structures, and there might be some pref equity, there might be some loans, there might be some mezzanine debt. And it's really important to see all of that and how it shakes out. Again, we do quarter over quarter performance. How do we do compared to last quarter? As you can see here, Q1 2025, we were actually up over last year, which is good, but there could be reasons. It could have just been the hotel outperformed. It could be last year we had a renovation, we had some rooms offline. So all that context would be in the kind of report up here. So we say the hotel is now fully stabilized following the completion of a renovation. So we had a renovation in 2024, which would have impacted some performance. Maybe that had something to do with our bottom line, or maybe we just weren't managing expenses as efficiently as we are doing today. And then again, the annual recap, what's the EBITDA been for the whole year, and what's been the income after debt service in this hotel. It's just over $1 million in income after debt service for the year. And it's important because people want to see the debt service. They want to know these quick things. And then again, we go for an operations recap. And you might say, like, what's the difference between the other recap up here and this one down here? Well, hotels are operating businesses that also own real estate. So in this instance, this ownership recap goes through the investment and anything from an owner's perspective. So this would include capital projects, major refinancings, any conversation around a sale. Whereas this down here, this operational recap, is very focused on the operations of the business from the manager's perspective. How is the hotel performing? How is it performing relative to its competitive set? What kind of business is it attracting? Are there new hotels coming into the market? Is it struggling with wage and labor expense? Is their guest service scores good or bad? All those sorts of things. And then again, how are you comparing to your competitive set? We have a snapshot of the star report there. In this hotel, we recently did a renovation, so you can see the before and after. Investors love pictures, so we always include a lot of pictures. And in this case, actually, we've shown some of the guest room renovations now for a couple of quarterly reports, because again, don't assume that your investors read every quarterly report. So maybe they're reading this one, but they didn't read it last month. And if we didn't include some of these before and after pictures, if they didn't read it last month, they wouldn't have seen it this time. So we sometimes tend to double up, and it's not a big deal. Most investors will forget they saw the photo anyways. So it's all good. And then here we go, quarter over quarter, really line by line on the hotel performance. So they can really see how we're operating the hotel and what the financial metrics are in the operating business. And then again, detailed star report. And then we go into the market report. So here's an example of a market report. This one is on Fort Lauderdale. We got it by CoStar. And you can either get these through your broker relationships, or if you pay for a CoStar account, then you can get it that way. But this really allows investors to read commentary from a third party objective source as to what's going on in the market. And I think that's important for context. And whether they choose to read it or not, we always put it in here. And it has, as you can see, a ton of information. And then any other additional information that investors might request, we will send over. Let's talk about mistakes, because we've made a lot of mistakes. And some of them weren't mistakes. They might just be better ways I've found to do things. One, it's a mistake if you don't clearly lay out what the returns have been on the investment so that an investor can easily see what that is. So what is the distributions to paid in capital? What is the um, projected residual value of the hotel relative to the paid in capital? These are all key things that investors should know and should be able to find in the investor report without having to call you. If you have a platform like Juniper Square, they can actually log in and see all that. So in our case, they can see it. We have it there on a dashboard, but it is nice to put it on the report so the investor can just have everything in one place. They could see what the distributions have been this year. They can see what it's been for the quarter, and they could see what it's been from the inception to date, from the beginning of the investment to now. Really important information to put there. It's best to put it in a little table at the top. I think investors always like to know if they're getting money or not. So put it at the top. That's what I would recommend. In the past, our investor reports have looked like a dashboard, like we jammed everything onto one page, literally one page. It was landscaped, and it literally looked like a crazy dashboard. And it was just a lot of information. It was cool that it was condensed to one page, but it was a lot to digest. And before that, we just wrote like kind of a letter, like a Warren Buffett type letter. It was just Word document. It looked like a memo, very official. We found that that was a little boring, and we wanted to spice up and be different than some other groups out there. And we didn't want it to look like an SEC financial report. So we've kind of landed in this middle ground where it's a little bit of a dashboard vibe, but there's some written, well thought out commentary that's direct, concise, and to the point. And that's where we are now. That's where we think it's great. Other mistakes that we've made is by, disclosing information that is not final, that ultimately doesn't materialize. And then you get investors excited about something or disappointed about something, and then it doesn't happen. It's not always the best thing to do. So you really have to evaluate and make a business decision what you want to share at that time and what you don't want to share at that time. Obviously, if someone calls you, you shouldn't hide anything. We don't. You should disclose everything, but it's just a matter of like what you want to share that's kind of live. And if you do share something that's not fully baked, make sure you articulate it clearly so the investor knows that this is still subject to change. Another mistake we've made is by having these long video webinars where we go through like 6 deals, and some investors are in those deals, some investors are not in those deals. I think it's good because you could do a state of the union, state of the world, what's going on at Dove Hill, all this information in the beginning, and then investors see their deal. But if you're only in one deal and you're not in 5 or 6, and you have to sit through 5 or 6 to get to your deal, that could be a negative. The other thing he used to do is live investor Q&As on these webinars. And it was good. It was fun. I like the engagement, but not all investors are going to be as sophisticated as the other ones. So you sometimes get questions that maybe would be better handled one-on-one. You get people asking personal questions in like a group of like 100 people that is not that productive. And we'd have for our investor webinars over 200 people show up, and some guy is asking like, hey, you didn't have the address right on my K1, and is like giving me an address over the whole webinar. That's not productive. Another thing that could happen in those is you have an investor express an opinion that may or may not be correct or accurate, and it might kind of taint the view that other investors have you or your firm. And I think it's best to have conversations with investors, generally one-on-one. It's not to say you can't have like an investor summit, but you want to really make sure that you're the one managing the expectations on the deal and how things are communicated. And you don't want investors to communicate things about your deal that may be correct, maybe not correct, maybe inaccurate, whatever it is. It just gets complicated. So I've found that doing live Q&As and webinars, particularly across multiple deals, is not beneficial. It's great for transparency. People see you coming out there, but it could backfire. I would not recommend doing it. If you have one deal and you want to do it, that's fine. We've certainly had a webinar with one deal where we're talking about, hey, we're trying to decide whether you should refinance or sell. and here's what we're thinking through, and then we ask questions. I think that's a very productive thing. But again, you're just going to have to make a business decision for what makes sense for everything that's going on in your business and in your world. Well, we got 30 minutes down, basically. That's everything I wanted to talk about, and how we actually, I'll give you one more thing that we've learned. We set dates and deadlines for our investor reports. So we know when our financials are going to be done. We know how long it takes us to do these write-ups, how long it takes to create these reports. And we set expectations with our investors very clearly as to when they can expect quarterly reports. For us, it's really 45 days or so after the end of the quarter is when we deliver them to our investors. So some investors just think this thing can magically be created the day the quarter's done, and that's not true. It takes the hotels at least 15 days to close the month-end books by the end of the quarter. And then you have to consolidate everything. Obviously, we have an accounting software that does that for us and a business analytics software that does that. But then we really have to write everything. There's other third-party reports that may not get delivered until later on in the period. So we found 45 days is really a good thing. And some funds that I'm investing in even do it longer than that. They might be doing it on 60 or 90 days, but they are reporting nonetheless. I think whatever works for you, you should do. And it's important to be consistent. Don't send an investor report 45 days later, then 120 days later, and then 30 days later the next time. That gets confusing. Try and space it out so that it's nice and organized and investors know, and make it easy for them to access previous reports. So again, we use Juniper Square. It's a great platform. You can log in and see all the communications, all the reports. We actually had an investor email us today. He said, hey, I didn't get a distribution notice through email, but then I saw it on my portal. So, maybe there was some glitch with his email address, but at least he could still access everything in his portal, which is nice. So that's everything I wanted to talk about. It covers how to create investor reports that people love. And I've got like 10 minutes or so to do some Q&A if there's any fun hotel stuff or real estate stuff that you guys want to talk about related to investor reports or not.
I was wondering, when you started, I think I understand, like, your family was in business. I'm curious about when you were like, were you always like the size that you are now? Or was there a time where you were like very small and you had like, what did your team look like day one versus what it is now? Like, because I'm thinking about, you said you have a full-time investor relation person. And I think for people that are getting started, they might just think, when is that day the right thing? And like, how do you think about scaling your team as you start adding more properties and more things? And then the next question I have is, how often do you think about doing some deals that you actually consider not raising capital and just kind of doing it on your own?
Good questions. So when I started Dove Hill, it was just me, and my dad was my partner, and he had 3 hotels of his own that he was invested in with another family, and he managed those hotels. But I didn't want to rely on that other family for capital. I wanted to go out and find my own investors and find new investors. And it was really hard because I had to find every single investor I had from scratch, basically. And we had no one. It was just me and my dad, and we had a hotel management team, but they weren't doing anything really related to the investment side. And then maybe you'd pull 1 or 2 people over, but I kept it pretty lean until probably midway through our second deal. That's when I hired 2 more people, another like an investment analyst and a project manager to assist on a development project that we were doing. And I like running things entrepreneurially, but ultimately you're only as good as the team and the people around you, and you just can't do everything yourself. And we made a lot of we just didn't do things as well when we were, that small. Our financials were not as clean as they are. Our reporting probably wasn't as good. I mean, I had to do everything. We had accountants and bookkeepers, but they aren't as sophisticated as the team that we have now. So, I some people that I've seen, go out and kind of raise capital to start a company, and then they have this big forward investment in all these people. And the way that I did it was we didn't raise any capital to go raise the company. I just did it myself. and I got capital from the first deal and each deal after that to go support the business. And as a result of that, our business, like our investment management business, has pretty much always been profitable because we had set up structures in place to bring in income to cover staff and to cover people. And it's hard to do that because, when you're starting out, sometimes the income that you're bringing in is not going to be enough to cover payroll, but there's other things you can do. Like you can hire freelance people. I mean, we utilize some um, freelance type people even today, and it's phenomenal, and you could pay them hourly or as you need them, or part-time. Maybe you have a part-time CFO, maybe you have a part-time analyst, and there's certainly no shame in that, and you can always fake it till you make it, and you could have their picture on your website and make your team look bigger than it is. But I started with nothing and only grew as the business could afford it. We didn't ever grow where like we were not profitable and we had to hire these people. We were in situations where we weren't making as much money because we had to make forward investments in certain people. But I think if you hire good people, hopefully they should pay for themselves. And to your second question, how we're set up is any real estate deal that I do, I bring in investors and outside capital. If I get to the point where I have a much bigger balance sheet and there's deals I want to do myself, maybe I would do that. But I want to be very careful about investors thinking that I'm picking and choosing deals. So actually in our current fund, we have an obligation to bring that fund into every single deal that I do, because I never want the appearance that, oh, Jake stays all the good deals for himself or his self and his family or self and his few friends. And then the okay ones, he ships out to everyone else. So that's something that is always top of mind.
The reason I ask you that is because I wonder if you ever presented a deal that you think it's going to be like, bringing it to everybody and trying to raise, let's say, $1 million. And let's say you had the money, that it would be even worth it to go through all that, or you wouldn't even. Is it because the investment amounts that you're looking at are always like large enough, or you also always know that you are targeting something that you always need to raise some capital?
Yeah, I see what you're saying. So we did a deal this year that wasn't or it was last year that wasn't in hospitality, but it's something that I want to grow into a new platform. And it was a small deal. It was $2.3 million or something like that. And we bought it all cash and then refinanced it out later. But I wanted to bring in investors in that deal, even though it was small, because I wanted to show investors what we could do in this different asset class, introduce them to what we were doing on a smaller scale, and then have them for when that deal size got larger. If I would have done it by myself, I would be able to show the track record, but at least investors now were in the deal. And if it's successful, they feel good about it because they're in the deal versus me just showing them a successful, deal that I did on my own. So that's my view on it. I think if you can do it on your own and you just want to do a one-off deal, then do it. But if you want to do it where it's maybe going to be part of a bigger thing or you want to make a business out of it, there's no harm to bring in people on a small deal. It's not that you have other people to talk to, but it's not all that more complicated.
And do you keep your splits and your structure, LPGP, like etc., pretty standard across because you're dealing with the same investors, so you kind of want them to like not feel like there's like changes in the structure and all that kind of stuff.
Pretty standard, although you should recognize that each deal has different levels of risk and maybe you adjust things based on the level of risk in the deal. So if a deal's more risky or very risky, then maybe the point at which I participate in some of the investors' profit is a little bit higher. Like the investors gets more compensated for the return. In a deal that's a little bit more stabilized, maybe that hurdle, that threshold is lowered and we participate a little bit earlier. But I do not vary too much. It's all pretty consistent. All pretty consistent. And I also, maybe I want to do a deal because I think it's a good deal, but the returns are a little bit lower and I'm going to take a little bit less because I want to do the deal and I want to make sure the investors get a minimum return that's going to be juicy enough for them.
When you started, was it like What was like your first couple of deals? Like how many people? Like right now, I think I have a 50 or 60 invest. No, maybe like 50 investors across all my deals, and I only have like 2, 3 deals, and they're very small. I'm curious, like at what point did it go over like 100 or like 1,000? Just
By the second deal, the first deal was very difficult to raise capital,
yeah,
but then the people in the first deal felt good about it. It was successful. So then they told their friends, and then we got more people for the second deal. And then it just spread from word of mouth. And I always ask our investors, I said, hey, we grow our business word of mouth. Is there anyone in your network that you invest with that might be interested in the deal? There's no shame in that.
but how are you talking about? You were able to do that after you had an exit, or just after you were like
No,
running?
we didn't even have an exit then, but maybe there were some distributions. And I think it was just, they liked investors oftentimes invest in the jockey, they invest in the person.
Sure,
So even if a deal is ongoing, but maybe you're not at the point where you're distributing yet, but they like how you communicate, they like how you share updates, they just like your approach, they'll still double down on a second deal with you because there's a real asset and they like the deal. So you don't need to necessarily have an exit to then go raise capital for a second deal. It's how you perform even before you have an exit. Now, if you're like raised all the money and then you just don't talk to your investors again, then, that's not good. I mean,
sure.
I could always do a better job keeping up with my investors and calling people. And, I think everyone can always do a better job at that.
And have you learned anything about racing like minimum amounts that you would tell us like not to do when it comes to like the minimum amount that you would
I think we're raising money for a deal right now. We're buying a hotel in Maine. It's an amazing hotel, um, one of the best hotels in Maine, and the minimum investment on that deal is 250,000. Now we always have the right to take less, like maybe I don't know, like a friend from high school or something was like, "Oh, I want to put in 50 grand." And I'm like, okay, fine. Um, but there's an art to figuring this out because you don't want to have people that say they're a sophisticated investor, but that really aren't, and then invest a small amount, and then they end up basically occupying all of your time. They call you every 5 seconds. They are very difficult to deal with. That could happen. So you want to be careful about that. And you also want to be careful setting minimums because let's just say you set your minimum of 25,000. Well, maybe someone will invest with you at 25,000, but if your minimum was 75,000, they would have invested 75,000. And now you have to go raise another 50,000 because your minimum was lower. So you really have to try and strike that balance. And I think a better approach is to set a slightly higher minimum. And if you feel on a case by case basis, there's an overwhelming reason to waive the minimum, then you can. And you're not doing it publicly, you're doing it privately. And your docs allow for it. But that would be my thought. Carly asked a question in the chat. She direct messaged me. I don't know, Carly, if you're still on, but
Hey, I'm here. Yeah,
yeah,
I
you
didn't want to
said,
interrupt. Sorry, because it's like
go ahead.
semantics
Said
question.
small ball question. Are you making these templates for your reports in-house? Was wondering what platform you may utilize, if so. So we, that's a great question. So our process is we write all of the words in Google Doc because we collaborate as a team. We'll have one person start it and then I'll clean it up and then we can edit it in there. And once we feel like the words are final, then we move it into the version that looks prettier. And that is done in Canva. And we like Canva, so we use that for a lot of things. And we've created that version ourselves. It wasn't something that we bought, we just created it. I like to do pictures, I like to do colors, I like it to look good. A lot of people don't invest the time to do that, and it looks like everything is just copied and pasted out of Excel. And then what we do for tables is we'll have an Excel document, and then we'll have another tab, and we'll make pretty tables in Excel, and then kind of like copy and paste them, the images into Canva so that we don't have any data issues. If something changes in the Excel model, it just sucks into that pretty version of it automatically. So we'll format the tables in Excel and then move them into Canva. That's what we do. And then we like Canva because, like Google Docs, you can collaborate with multiple people. So we'll make comments. I'll be like, oh, I don't like how this looks, or move this picture around, or change the picture, or the table is blurry or something. And it's convenient.
Perfect. Thanks so much.
Yeah, exactly. Um, anyone else before we hop?
Hey Jake, when you're looking to make an investment in a hotel, do you ever look at what's the minimum amount, like money that the place is going to generate, or else you won't actually look at it? Like, what is the absolute minimum that you? Yeah, I won't do because I was looking at those numbers there, and I see like, okay, EBITDA after that service of $1 million. I'm like, wow, that's pretty healthy right there. So I'm curious, like, what's your thought on that, or how you look at that?
Well, um, on that hotel, I think it's okay. But that one should be doing a little bit better. The market had a lot of supply come in, and occupancy rate is up significantly over the past 4 years, but occupancy is still a little soft because there's so much new supply. So yeah, until COVID, people really never looked at what the worst case scenario was. And then you had to really figure out during COVID, like what was kind of the bare minimum you needed in revenue in order to basically pay your debt service and pay your employees and stuff. So, one way to think about it is debt service coverage ratio. For me, I always think, you don't want to get foreclosed upon. So the worst scenario is not being able to pay your debt service. So on your model, you can really just sensitize things like, what if this happens? What if this happens? But we will also oftentimes underwrite deals that like are going backwards. Like we buy them at, I don't know, making this up, $2 million of income, and maybe next year we think there's only going to be 1,800,000 of income. There could be different reasons why that happens, but things just don't always go up forever. So you have to be realistic with what's changing in the world, what's changing in the local market. Are wages rising faster than you're able to increase room revenue? These are all things that have to be considered. But at the end of the day, most things are solvable if you can pay your debt service. If you can't pay your debt service, then you now have to renegotiate with the lender. It's just annoying. You have to do a workout, and they might try and foreclose, all these different things. So you want to make sure that going in, at least for us, we have healthy coverage over our debt service, or enough of an interest reserve to get us to a point where we've achieved our business plan and we think we won't need that. The other thing is we never over distribute. We're always much more conservative in distributing. And we might say, hey, we've got, for example, we have one hotel. By the end of the year, we're planning on potentially selling it, but we also may need to refinance it if we don't want to sell it. So by the end of the year, we're going to have $2.5 million of cash on our balance sheet. Now, I could have distributed all that throughout this year, but what happens if I go to refinance and the lender wants something for an extension, or it's not a refinance, it's an extension, but the lender wants a pay down, or I have to renovate something? You really don't want to do a capital call. So we're always very cognizant to build in operating reserves so we don't have to do capital calls. No one wants to have all these distributions and then you start doing capital calls. Like that's not good. And we've been there, we've done that. So we always build in a little bit of a cushion, and it's okay to see how things go. We have a cash flow meeting every month for each one of our properties. We had one yesterday, and we were talking about distributions, and I'm like, okay, well, let's distribute 100,000 this month, so tomorrow, and that would leave us with 200,000 available. And at the end of the year, that looks pretty healthy. But we can always revisit that. Maybe we distribute 100,000 this month, and then we look again, 2 months down the road when we get our tax bill, or when the insurance bill comes in, and we get a little bit more clarity on how the end of the year is going to go. And then we could be like, all right, let's distribute another 50,000 because I'm fine getting to the end of the year with just $100,000 in reserves, or whatever it may be. So you can always hold a little bit, distribute, hold a little bit, distribute, hold a little bit, distribute. The investors will say they want distributions, but when times get tough, they're going to say they don't want to do a capital call. So you, as the sponsor, as the entrepreneur, have to be the disciplined one and manage that. And we'll also don't necessarily just want to hold on to cash forever, because that could screw up your IRRs.
What about the revenue? I'm just curious. Like, do you ever look at the revenue and how much, like the actual dollar value? Like you could say 20%, but if it's like 50,000, you might be like, yeah, no, I'm not gonna work for that much. Is there like a number that at this point you're like, if we're not making over X amount of revenue, X amount of NOI, X amount of monthly, X amount of doors, things of that nature?
Yeah, I mean, we get shown deals all the time for like a hotel, but we're buying a hotel that's like around 30 keys right now, and it generates almost $2 million a year in income. So it's just all dependent, because that hotel has a huge ADR. You could show me a 30-room hotel that's only generating, 200 grand. We wouldn't do that deal. It's just not worth it for us. We don't need to do that.
Sure.
And the juice isn't worth the squeeze.
Thank you. Awesome.
100%, man.
Hey everyone, it's Jake here. Thanks again for joining me on this conversation. Be sure to subscribe on Apple Podcasts, Spotify, or YouTube. Lastly, don't forget to follow me on Twitter at @JWurzak. I'll see you in the next episode.
Jake Wurzak is the founder and CEO of Dove Hill Capital Management. All opinions expressed by Jake and his guests are solely their own and do not reflect the opinions of Dove Hill Capital Management. This podcast is for informational purposes only and does not reflect or represent real estate, financial, or investment advice.